Good evening and welcome to our webinar tonight on disability insurance for residents and young physicians in transition. My name is Mike Hegwood. I'm the Assistant Vice President of Brokerage Marketing for AMA Insurance. And joining me this evening are Kendra Henderson and Dan Krause. Both are insurance specialists with our agency. And collectively, we've got years and years of experience in the insurance marketplace, and we're thrilled that Kendra and Dan will be joining us tonight. Both of them specialize in disability and life insurance, and they do work with residents, students, and physicians all across the United States. Also joining us this evening, kind of behind the scenes, is Stephanie Swartz, and she will be helping advance some of the slides. So you may hear me refer to her name from time to time. Stephanie, if you wouldn't mind advancing to the next slide. One more, please. Okay, before we jump into the topic this evening, I think it's always important to share a quick disclaimer with people attending our events. First off, I want to make sure everyone knows AMA does offer a disability insurance plan. We have since 1974. We offer a number of different plans. We do earn a commission from the sale of a disability insurance contract, but I think it's important to note that the individuals on this call this evening, in particular Kendra and Dan, operate on a non-commission basis. That's very important to us as an agency. We want to make sure they are in a position to help people purchase the plan that best meets their need, and there is no bias towards any sort of commission. So that's the disclosure I want to share. Stephanie, if you could move to the next slide. These are the discussion points we'll be covering this evening. We're going to spend a few minutes talking about whether group coverage or individual coverage might be best for you. We'll also talk about the sequence of the purchase and whether or not that matters. We'll discuss this concept of who's assuming the risk and how that impacts pricing. We'll also touch on some other considerations. And most importantly, we will open this up for questions at the end. But I would also encourage you, there is a chat function. Feel free to submit your questions while they come to mind. I will try to field as many of those as I can as we go through the topic, but we will certainly address each and every question as we wrap things up in about 20-25 minutes. Stephanie, next slide, please. Okay, so to get started, just to set sort of some basic understanding, most people on this call are going to be familiar with disability insurance, but according to Copilot, as of March of this year, disability insurance is a type of coverage that replaces a portion of your income in the event that you're unable to work due to illness, injury, or other medical conditions. So that's sort of the framework around what disability insurance is, whether we're discussing group or individual. Stephanie, if you could advance to the next slide, please. So as we get into this topic, and I'm going to ask Kendra and Dan to chime in here in just a minute, but let me set the stage here, just high-level overview. On the left side of this screen, there's group insurance, typically offered by an employer. Some of the pros and cons of group insurance: it's going to be fairly inexpensive, but it's going to have limited benefit amounts and/or features. Tends to be generic to occupation, might not be something you can take with you in the event that you change employers, but it is easy to purchase. Typically no underwriting requirements and so forth. Rates could increase. There are some limitations in terms of the features that you can add on to it and so forth. But the big takeaway is, on the group side of the ledger, typically easy to purchase and inexpensive. Individual coverage is typically offered by agents. You can buy it direct online as well, or direct to a carrier, but typically through a professional agent. These tend to be a bit more expensive. They do offer richer benefits. The definition of disability is often more specific to your occupation. It is coverage you can take with you. It will have underwriting requirements typically, and so it can be harder to purchase. The contract typically cannot be canceled. Rates tend to not increase. They get locked in, and you can customize the plan per your specifications. So the key takeaway here on the individual side of the ledger, a bit more expensive, but also a bit richer in terms of the benefits that it provides. So with that being kind of the basis, Kendra, let me start with you. In your experience, which of these plans do you see being presented to residents and young physicians first, and why?
Many times the group plan is often offered first. A lot of times while you're in residency, your residency is offering that group insurance while you're in that program. Like Mike said, that's not portable. Usually, once you finish residency, it's not going with you. It's just a benefit that's offered when you start your residency program. It's also a benefit that is offered once you start your attending position. Once you've started full time in a position, it's usually offered as part of your benefits package. When you start, sometimes what we're seeing, and we're seeing it more and more, you have to work there for 6 months before those benefits are being offered, but it is usually offered as part of your benefits package.
Okay, so thank you. So the takeaway is these plans both can be offered to residents while they're in training, and certainly to physicians transitioning into practice. They're probably going to see both of these being presented.
Yeah, absolutely. You probably have already been contacted about individual plans, maybe through your residency program as part of your finishing. The end of the year programs that they offer you. They've brought in different agents to talk about individual plans. You're definitely going to start getting more individual offers as you're starting out as a young physician in your position as well.
Okay, thank you, Kendra. Dan, let me go to you now on this. So you can look through these different pros and cons and the different makeup of the plans. But from your experience and your professional opinion, if you were to provide some guidance to, let's say, a resident or a young physician, what, in your opinion, should they consider as they sort of think through which of these plans may be best for them at this stage of their career?
Yeah, I think the main one that I usually start with is portability. Excuse me. Oftentimes we talk to physicians over the course of their careers, and they're changing jobs. They're going from working for an employer to private practice, and your group insurance that you're going to get through those employers is not going to be able to go with you when you switch positions or go to private. So if you're going to get an individual product when you move into your first job, that's going to be able to go with you throughout your career, and in some cases grow as you move through your career. So that will always be there. So that to me is one of the more important parts of making that decision on which one to go with and when.
Okay, thank you. Yeah, so that portability piece is a key part of the decision process. Okay, thank you. Stephanie, would you mind going to the next slide? So now I want to touch on this idea of the sequence of purchase. And Kendra, in a minute here, I'm going to ask you to take the group through kind of an example of what we mean by that. But Dan, let me start with you. We just showed that slide that had group and individual. Let's say a young physician, whether they're in residency or the first year or two of practice, let's say that young physician decides to purchase both. Does it make a difference which one they purchase first?
Yeah, it will. So every insurance company has what they call participation limits, and that's going to be the amount of income that they're going to be willing to insure that you have. So They also, part of that, they take into consideration how much disability insurance you already have. So if you were to, get a group plan first, that may create limits on what you're able to add to that, just depending on what your income level is at the time that you're looking at the insurance.
Okay, thank you. That makes sense. Kendra, just to sort of drive that point home, could you take the group through this illustration that speaks to how these participation limits work?
Yeah. So in this example, this physician has an annual income of 200,000. Most insurance companies won't underwrite you for more than 66 2/3 your total annual income. So in this example, that total is 11,100 of monthly insurable target. So in group A, so if we're looking at group A, this physician has $10,000 of disability coverage right now through their employer. With that participation limit being at 11,100, the max they're eligible to get through an individual policy would be an additional $1,100 a month in coverage. So they're maxed out basically already at that 11. They've hit that participation limit if they buy both of those. However, as you can see in group A, they have 10,000 in group coverage. So if they change jobs or move to a different state, that policy isn't going with them. So the only policy they're taking with them is that that $1,100 a month in disability coverage. But if we look at group B, and Stephanie, if you want to go ahead and click that, this physician has purchased 7,500 in individual coverage. In this scenario, that's how much the individual carrier is willing to underwrite them for, is 7,500 a month in coverage. But if you look, let's say 5 months later, they've gotten this policy before they've started their position. Once they start and their benefits kick in, they get an additional, go ahead and hit that, Steph. They get an additional 10,000 a month in that group. So they're insuring 17,500 a month in coverage. So should they leave this job or move to a different state, that 7,500 is going with them. So let's say they move to a job that doesn't offer them disability at all. They've already purchased a plan that's going to go with them, and they're not worried about that additional group coverage. Whereas in scenario A, they purchased this 5 years ago. They may need now to go purchase an additional plan or up the coverage that they currently have. And that at this point could be more expensive because now they're older and disability is based on not only your income, but your age as well.
Okay, thank you. That makes some sense. Now, Dan, I'm going to go to you because I see the footnote down there to the right where it says there could be offsets that still apply to the group coverage to prevent someone from being overinsured. So to Kendra's point, in this example B here, the individual can purchase the $7,500 of individual coverage and then layer the group on top. But if the offsets kick in, the group might only pay up to that 11,100. Is that a fair statement?
Correct.
Okay, so that's correct. So then let me ask a follow-up question. In the event that a group plan would offset, is there still a benefit for someone to purchase the individual plan first rather than getting the group coverage first and purchasing individual second? Is there still a benefit in this example?
Yeah, if your $200,000 annual income becomes $300,000, then that participation limit, I haven't done the math, but it goes up. So the amount that your group coverage will pay in addition to the individual plan will also go up. So you're actually kind of setting a buffer of how much income you're going to be able to insure over time as your income increases when you have the individual plus the group plan.
Okay. Okay. That's a great point. So let me go a step further then. It sounds like this idea or this concept of the sequence of purchase is particularly important to a younger physician as they're growing into their career and anticipating future lifts in their income. Purchasing that individual plan first gives them a bit more flexibility and opportunity to purchase more overall coverage. Is that a fair statement?
Yeah,
Yeah,
the timing
exactly.
is key.
Timing is key. Okay. Excellent. Okay. Well, thank you both for commenting on that. I think that's an important takeaway. A lot of people don't quite understand that concept and get stuck in scenario A and then get limited in what they can purchase and take with them, especially in training as they wrap up their residency, leave. The portability of that group plan doesn't travel with them. And so all they're left with is the $1,100. So great conversation there. Appreciate you both chiming into that. Steph, if you could go to the next slide, please. Okay, so now we're going to pivot here just a little bit, and we're going to talk about who assumes the risk, why it may matter, and what sort of impact it has on pricing. So this is a simple little diagram. Obviously, the more risk you might assume as a individual, the lower the price. The more you would push that risk onto a third party, an insurance company, for example, typically the higher the price. So I'm going to ask Dan and Kendra to comment on that here in just a minute, but let me take it a step further and give our audience an example of what I mean by this concept with another type of insurance product. So most people are familiar, obviously, with health insurance. If you think back a few decades with health insurance, a lot of people purchased health insurance with a 0% deductible. In layman's terms, that meant the entire risk was offset to the insurance company. They handled all the risk. If you had any sort of claim, any sort of illness, you got covered and you got a benefit paid out. But as premiums for that type of coverage continued to increase, the emergence of these high deductible health plans paired with an HSA account started to become popular. And what that simply did is by a consumer, let's say, electing $1,000 deductible, they're taking on some of the risk. And as a result, they were able to get a lower price from the insurance company by being willing to take on some of that risk. So you're covering $1,000 of the risk on your own, you get a lower premium from the insurance company. So a lot of people are familiar with that on the health insurance side of the ledger. That kind of product has been around for quite some time. Let me shift back over to the world of disability insurance. And Kendra, from your experience, I'll start with you, and Dan, I'm going to ask you to chime in as well. But can you provide the audience with an example of how this concept would be applicable to disability insurance?
Sure. When you're talking about individual disability plans, there are a lot of different plans in the market. There are plans that are very rich and high in benefit. If you select a plan with a lot of bells and whistles, that plan can become very expensive, meaning the premium is very high. Now, the benefits are very rich to you, but you're going to pay a very high premium for that. There are other plans in the market that, maybe the plan isn't as expensive, but the benefits aren't as rich. But again, the premiums aren't as high. So when you're looking at disability, you're kind of weighing your options on the amount of premium that you want to pay and that high premium to those high benefits, or maybe still a rich benefit, but are still a good benefit, but you're taking on more of that risk, maybe with a longer waiting period. Those are just some of the ways that that kind of translates to disability.
Okay, thank you. Dan, could you provide another example along those lines?
Yeah. So let's say, for example, the participation limit, like we talked about on one of the previous slides, was 15,000. So you can insure up to 15,000 of your income, and you decide that the premium's not feasible, and you're willing to take on more of the risk, if you will. So you're just going to insure 7,500 of it. So that's one way you take on more risk, and then transfer some of it to the insurance company. But then you can also stack, again, what we talked about before, stacking group coverage on top of it. Group coverage isn't quite as robust as an individual policy is, but it will still cover you in that catastrophic situation. So that's one way you can save on some premiums, still be pretty well covered, but also allow the insurance company to assume some of the risk of your disability.
Okay, great. So thank you. So that third bullet on this slide is sort of important then. You need to understand or define the level of risk you might be willing to assume, and then that'll help guide you on the type of disability product that you might then want to purchase, and then the corresponding pricing that goes with it. So a lot of options out there. It just depends on what people want versus maybe what sometimes they get sold. It depends on how much of that risk they want to cover.
Absolutely.
Exactly.
Okay. Well, thank you both. Okay, Steph, could you go to the next slide? I want to kind of wrap things up, and then we're going to get to the Q&A session. But I want to get both of your opinions on some of these other considerations a resident or a young physician might consider when they are thinking about purchasing a disability contract. So Kendra, let me start with you. This idea of special offers, could you comment on what that might mean and what a young physician might think about?
Yeah, as you're a finishing resident, getting started in your career, this is the time you're going to see different insurance carriers come out with what they call special offers. Maybe because you're young and healthy, maybe they are going to waive medical underwriting. They're going to give you a guaranteed issue plan, of up to a certain amount so that you don't have to go through underwriting. Also, being that you're young and just starting out, there may be policies out there that they are, willing to offer limited underwriting or just a couple of medical questions. As you're moving through these, because you're young, because you're just starting out, there are different options that different companies will come to you with, especially being a finishing resident. This is probably when you're going to see those special offers that different insurance carriers are going to be willing to offer you.
Okay, thank you. Dan, I'm going to go to you on the next couple. So could you elaborate a bit more on the tax implications? And we touched a little bit on portability already, but could you elaborate a bit more on the portability issue as well?
Yeah, tax implications. So if you get group insurance through your employer, more often than not, that insurance is going to be paid for by your employer. And so if you have a disability situation, those benefits are paid out to you. They're generally going to be considered taxable income. So you're going to have a taxable event when that sort of thing happens. With an individual policy, that is paid for with your after-tax dollars. So any benefits that are paid out to you from that coverage is generally not going to create a taxable event. So if you have a $10,000 benefit with an employer, you're going to have $10,000, but then it'll be reduced by whatever the taxes might be. If you have an individual plan worth $10,000, your benefit is going to be $10,000. So there's considerations there that you have to keep in mind with those two different plans. And portability, again, your group plan that you get through your employer is generally not going to be able to go with you. So if you leave an employer, all of your benefits are going to stay with them. So your individual plan, that is yours, you possess it. So if you move from employer to employer, move from employer to private practice, whatever it might be, you're going to be able to take that plan with you.
Okay, thank you. Kendra, I'm going to wrap up with you, the last two. So you've worked with a lot of residents. In your professional opinion, are there certain features you would recommend they look for in a disability product? And then would you mind, sharing what sort of pricing expectations they should consider, what kind of price they might want to or might have to pay for those kinds of plans?
Sure. There's a couple key features that I encourage my residents to look at. One of those is the definition of disability. You want to make sure that you're protecting your occupation. You went to school for a really long time. You've probably paid a pretty penny for that occupation. You want to make sure that you're protecting it. So a good benefit or a rich benefit as far as the definition of disability, we call that true own occupation. That's one of the key features I push my residents to look at. Also, another one, other key features that we offer that are offered: catastrophic disability, cost of living adjustment. Those are different features that you'll see. But another one is looking at what we call either level rated premiums or separated premiums, how you want to kind of pay for that. They're different features, but they're priced differently. A step premium, starts out at a lower price point, gets more expensive as you get older. I do have a lot of residents that like that feature because maybe they're, as they're transitioning out of residency to a full-time attending position, maybe they're paying for moving expenses. Maybe they're paying, student loans off. A lot of them like that step premium coming out of residency because as their income is lower, they can pay a lower premium. There's also in the market, there are level premium products. Those are more expensive, higher price point, especially for, doctors with a high occupation class. So when you're looking at these, you kind of need to look at all avenues of what is being offered and what best fits you personally, so that you're getting a product that is suited to you and not just suited because someone else said it was. You need to make sure it's a product that fits you personally.
That last point, I think, is really important. Disability has a lot of different options. There's a lot of different types of products you can purchase. They all have different implications, different price points. And so understanding what sort of level of risk and what you're after is important. And that might help guide you down one path or the other versus being sold something that you might not necessarily want or need. So great comment, great points. We're right at the bottom of the hour. Steph, if you don't mind, if you could advance to the next slide. I want to make sure we have an opportunity here to field any questions from the audience. We're certainly happy to stay as long as people have questions. I'm looking at a few now that have come in, and let me open these up. I do want to point out, I've listed Kendra's name, contact information, along with Dan's name, email, contact information. Feel free to reach out to any of us if you have additional questions or want to talk more about any of these things. We are happy to do that. Okay, so here's the first question. What is the difference between long-term and short-term disability insurance, and do we need to have both? Either of you want to address that first question?
I'll take that one. So the main defining difference between long-term and short-term is how long the benefit is going to pay you for. So if you have a disability situation, short-term disability, more often than not, is going to have a payout period of somewhere between 6 and 12 months. It's not going to pay you forever, if you will. Long-term disability, on the other hand, is designed to pay for a number of years. You're going to see a number of different ways that it's defined. Generally, they're usually paid to a certain age. So like pay to 67, for example. If you have a disability situation at 40 years old and you meet the requirements of the claim, that will pay you until you're 67 years of age. And it does typically take longer to qualify for the benefit to start paying to you as well. So it's really designed for that catastrophic event where you're going to lose your income for a long period of time. Short-term disability is designed for something that probably won't knock you out of working for, potentially the rest of your life.
Okay, great. Thank you, Dan. Next question. If I start with $200,000 of income first year and I can insure $11,000 a month, 5 years later I make $400,000, and if I want appropriate coverage, do I need to buy additional coverage separately, or can I adjust the plan I already have?
I'll take that. So a lot of times companies will let you adjust the plan that you already have to increase the amount of coverage that you have. It depends on a lot of times. There are some carriers that will increase it without you having to go through medical underwriting again. There are some carriers that will require you to do some additional underwriting just on the additional amount that you want to carry. A lot of times, if you've maxed out what that company is offering, you can stack another policy on top of it. So I would say if your income is jumped that much, I probably would look at increasing the amount of coverage that you're carrying for your disability.
Kendra, do you also see, and I hear it referred to as different names, but a future increase option, an automatic increase option, things like that. Would those kinds of features be available in some of these plans?
Yeah, a lot of times, a lot of plans do offer a future increase option. Depending on the plan that you get, it may already be written into the plan when you originally get the policy that you have the option to automatically increase, an additional 5,000 or, up to the max of whatever that company offers. Sometimes there are limits on how long you can take to exercise that. There may be, say that you can only do it within the first 3 years of taking out the original policy, or you can only do it within the first 10 years of the original policy. So every carrier is different, but FIOs are very common on a lot of plans.
Okay, so an important feature maybe for young physicians to look at to address their increasing income over a period of time.
Definitely.
A follow-up question on the future increase option. Does that mean they have to go through additional medical underwriting or financial underwriting, or both?
FIOs, usually you don't have to go through the additional medical underwriting. It will, if the FIO is already included in their plan. As far as financial underwriting, yes, you have to be able to prove your income. Okay. So whether that's, last year's tax returns or last 4 pay stubs, something like that, you are going to have to prove that your income will support that increase option.
Okay, great. Thanks for the clarity there. Sometimes I think people get confused. You do have to justify the increase by showing your increased income, but you don't have to go back through the medical underwriting.
Not with a future increase option.
Great. Important to know. Next question. Regarding the sequence of purchase, how do you navigate this if our hospital system has already enrolled us in long-term disability with our benefits active at our start date? Does that mean that we only have access to a smaller amount from an individual plan? In essence, we are automatically forced into the sequence of Group A. Let me chime in on that one first, and I'll let you guys comment on that. Kendra mentioned earlier at the stage of being a resident or young physician, you are presented with a lot of special offers. This sort of falls into that a little bit. So you are likely to be presented with what a lot of carriers refer to as a starting practice limit on your individual plan. So regardless of how much group coverage you have, they'll allow you to purchase at least $5,000 of individual coverage, knowing that your income is likely to grow as you go into practice. So that's one way that that can get addressed. Kendra or Dan, any other thoughts on how that gets addressed? In the event, let's say they've got the group plan in place at the hospital, the teaching hospital, assuming they leave the teaching hospital and go find employment somewhere, that group plan ends. And at that point in time, do they have a clean slate as they go into their next employer?
Yeah, I would say I tell a lot of my residents, as soon as your residency program's over, that policy ends. You're done with that. And a lot of times residents do have, a gap, maybe a month or 2 or 6, before they start their attending position. If you do have that signed contract, you can go ahead and purchase an individual plan before you start. Like Mike said, a lot of them will allow you to purchase up to $5,000 to be able to, as you're going into that. But as long as you have a signed contract showing what your annual income is going to be, most carriers will underwrite you during that gap period.
Okay, great. Thank you. Okay, we've got several more questions, so I'm going to kind of roll through these. This one, I joined a few minutes late, so I apologize if this was already covered, but I have been advised to try and stick to a GSI, guaranteed standard issue, to avoid being denied due to prior conditions. Is this standard practice when looking for plans? Are there individual plans not affiliated with residency programs that would still be GSI? Either of you want to comment on that one?
Well, it's kind of that can be a tricky situation. So if you've been advised to try and stick with GSI because of prior health conditions, it's a lot of other companies are going to require full-on medical underwriting. So if you have a medical background that can potentially be tough to get through that medical underwriting, then yeah, GSI is probably the best situation for you because it's not going to require as much of the underwriting that they're going to want to do.
And yeah. I'm going to comment on that too, just for a minute. I will say, anytime that you apply for coverage, that you go through full medical underwriting, if you get declined on a policy that you apply for, whether that's life insurance or disability, it will make, if you try to get insurance in the future, it will make it that much harder. Right. So just being aware of those medical conditions that you have, and being upfront with whoever you're talking to, whether that's an agent. A good agent will walk you through those issues that those medical conditions that you have, and try to help you navigate that, as it sounds like somebody's kind of giving you that advice already, that GSI might be the best way to stay for that. I know that I try not to put anybody through underwriting that has the potential that has a high potential to get declined, because it will make that harder for you down the line in the future for any additional coverages you want to purchase.
Yeah, thank you both for chiming in on that. Many more questions surfacing, which is great. A lot of these questions are really, really good. Let me rattle through a couple more. Maybe this will be covered later, but what if your income is variable based on performance each year?
Yeah, typically insurance companies are going to use an average monthly income to determine what your insurable limit is. So if you're random numbers, if your income's 10,000 one month, 12,000 the next, 20 the next, they're just going to average it out. And that's what they will use as the number to determine how much of your income they will be able to insure. So typically when I talk with a person, I ask for what their annual income was the year before, and then just divide it by 12, because that's going to give us the most accurate assessment of how much income we can insure for a person.
Yep.
Okay, thank you. Next question. If we are hoping to lock in a resident rate for an individual plan and we are currently in residency and we have group insurance in residency already, would that have implications for the sequence of disability purchase for when I am an attending? In other words, would I fall into scenario A in the previous slide? Should I wait until my residency contract is completely over before buying an individual plan? I think we touched on this already, but either of you care to comment further on this?
I would say you should look at once you've signed that contract and we're getting close to the end of residency, that's probably the time that I would look at, applying for that coverage. Residency necessarily won't come into play because we know that you're finishing. But usually those 2 or 3 gap months, that's usually when you'd probably want to apply for that.
Yeah, I was just going to say the other thing you can consider, if you have the group insurance through residency, a lot of offers like Kendra had talked about earlier, you'll have the ability to still purchase an individual policy, and they're not going to look at what your income is or what other insurances you have. It's going to be limited to how much they'll let you get. So you can still do that during residency and then take advantage of those FIO options that you might have with the coverage down the road as well. So it allows you to get that coverage while you're in residency and just exercise an FIO later on too.
Good point. Yeah.
Future
Okay.
options, yeah.
Good advice. Next question. What types of riders do you all think are necessary to have as a new attending?
I'm a big proponent of true own occupation. That one I really feel strongly about. It's one that I tend to talk about a lot when I'm on calls. So definitely that. I'm also a big proponent of catastrophic disability. I've seen a lot of younger people lately, and this is just personally in the life that I've lived, strokes. I've seen a lot of younger people, they've been affected by a stroke, 35, 40 years old, had a stroke and have had to learn how to learn how to talk and walk again. So I'm a big proponent of both of those, catastrophic disability and true own occupation.
Okay, thanks. Dan, any comments?
I'm in the same boat. I do think it kind of goes back to our risk and price conversation. When I talk about riders with people, I'm always like, this is kind of a personal preference of how much risk you want to assume when you purchase a policy. Adding the riders, that's going to cost you some extra dollars to put those riders on there. And I find people more often than not do want to put, especially the true own specialty rider on. That extra level of protection is definitely important for a lot of people.
Okay, thank you. I'll add one. From my perspective, a physician at this stage of their career typically is never going to be as healthy and obviously from an age standpoint as young as they are in the rest of their career. And so typically that creates an opportunity to get a really good price, good coverage, and then I would add the rider for a future increase because you're leveraging your good health now while you can. So you've got a good base amount, but you might be in a position to really get a strong future increase option that you can exercise later if you wait to purchase a second policy 10 years later, who knows what sort of health conditions may have occurred during that period of time. So that's another one I would add to the mix as well. But I think that the definition is certainly a critical one for most all of these physicians. Okay, one more question for now. This pivots a little bit onto what we just discussed with the FIO. Does locking in a plan with an FIO while we're young, earlier in training, provide lower premiums when we exercise the FIO compared to waiting and purchasing a similar level of insurance at the time we might otherwise exercise the FIO? So if I buy now and I exercise the FIO in 5 years, am I paying young rates on it, or am I paying a current rate on it?
I understand the question. Generally, yes. Buying now, exercising FIO later is going to be less expensive for you than waiting till, say 5 years down the road to buy that same amount of insurance. Like that Mike was pointing or alluding to, buying when you're younger typically is going to be a way to save yourself premium over time, especially when you exercise an FIO down the road. You will pay the difference for whatever you increase your coverage to. But if you waited until you got to that point to buy extra coverage, then that will cost you more.
Okay.
As you said, Mike, the younger you are when you purchase that policy and the healthier you are, the least expensive it is.
Let me go a step further. So let's say I'm 30 years old. I purchased a policy, and let's say it's a $10,000 policy. It's got an FIO provision in it that allows me to exercise another $5,000. So I'm 30 today. In, let's say, 5 years, I'm 35, and I want to exercise that 5,000. Will I pay, from a rating standpoint, will I pay 30-year-old rates on that $5,000, or will I pay 35-year-old rates on that $5,000?
You'll pay a 30-year-old rate on that 5,000 because you got it as an FIO. It's a future increase option. That's the point of buying it younger, is locking that in for that lower rate.
And I believe that can vary by plan. So
It can. Yep.
Some carriers will exercise that additional increase, no underwriting. So you can exercise it if you can prove it that your income is increased, but it's going to be on the older rate, the 35-year-old rate versus. So it's a great point. It's a great question. And it's a great comment from you, Kendra. Different companies handle that differently. So it's one of those examples where you really want to understand the details so you know exactly how that will play out in the event that you choose to exercise that FIO.
Yes.
So great comment. Okay. Let me see if there are any other questions. There are a couple more. Incoming intern had one of the big five set up a meeting with us as they are affiliated with our institution. Can I shop around and get quotes from other agencies, or am I stuck?
You absolutely can shop around.
Yeah, you are not stuck. A lot of schools and residency programs will have use the word affiliation with different companies who have worked with the administrators in the schools to set up that sort of arrangement. It's beneficial for you because you're going to learn about the disability insurance, but yeah, just know that they're not who you have to buy insurance from. You can shop around to anywhere you want.
Yep.
Yeah.
I encourage people to shop around.
I think the more that you do shop around, the more educated you become.
Absolutely.
The more educated you become, the more confident you become in the decision that you make.
1000%.
So, yeah, I echo those comments. Let's see. I'm going through, I think we've covered all the questions. Let's see here. we'll see if any more come in. While we're doing that, Kendra or Dan, any closing comments or words of wisdom you want to share with the audience from your experience in working with, young physicians, residents in training, first couple years of practice?
The only thing I would, and it actually kind of goes back to the last question that was asked, make sure you look around at different options, talk to different people. Don't, feel pressured like the person you're talking with is the person you have to buy from necessarily. So, kind of learn as much as you can about it before you make the decision, because it can be a costly mistake down the road if you get into something that wasn't, right for you or what you needed.
Okay, good.
Yeah, the sentiment I was just gonna, I agree with Dan 100%, but I will add that make sure the policy that you're getting is a policy that fits you. Don't get, a policy just to get one. Make sure that you're talking through all of the things that you'd like to have, what you want to see happen should something happen to you. Nobody ever wants to think about, okay, well, what would happen if something happens to me? But those are the questions you kind of have to ask yourself to know what kind of plan is going to fit you best and know how it's going to affect your family.
Yeah, thank you. Thank you both. Last question. Can we get a recorded version of the webinar? Absolutely. We will send a follow-up to all those that registered and attended this evening, and there will be a link to a recording so you can review it again. I'll also mention one more time, feel free to reach out to Kendra or Dan directly. They work with young physicians all across the country. They've been doing this for a number of years. They specialize in disability and life insurance and would be happy to help educate you on the options that are available. So I'm going to check one last time. I believe, got one last question. Sorry. Already touched on it earlier, but I was told if I apply for an individual plan and get denied due to medical history, medical underwriting, I will not be able to apply for GSI or will be severely limited in my coverage options due to an exclusion rating. It is unwise to apply for an individual plan. Are there any other alternatives, or is GSI sufficient in most cases? Now, a lot to unpack there, but either of you want to tackle that one?
Underwriting.
Go
Yeah, I was just going to say, from an underwriting perspective, we talked about risk and what you, the consumer and insured, are willing to take on. Insurance companies also have a similar metric of how much risk they're willing to insure for a person. And the medical part of it is a big part of that. So even if you are declined by an insurer, that doesn't mean no other insurer will ever insure you again. GSI, yeah, it's likely that they won't, because they're only going to ask like 5 or 10 questions, and one of them is going to be, have you ever been declined for insurance before? And if you mark yes to that, they're not going to be willing to continue with the application. But for example, if we run into a situation where one of the people we're working with is declined, we reach out to a partner we work with and ask them, because they have access to other companies, and say, hey, is there another company that may look at this person? Here's the situation. And generally, they're usually able to find another company that will consider it. So you're not automatically knocked out of individual insurance for getting declined, but you probably won't get any more GSI offers if you're ever declined by individual.
Yeah.
Good. Okay. Well, listen, thank you both for your time this evening and your insight into this market. I think it was very helpful, very insightful. And thank you for those that participated this evening. Again, just to reiterate, we will be following up with a message in the coming days with a link to the recording if you'd like to review any of the material we covered this evening. And again, if you'd like to reach out to Dan or Kendra, their contact information is on the slide. So with that said, we'll conclude tonight's webinar. Thank you again for participating. Hope everybody has a great rest of the week. Thank you again.